Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a Loonie in any of these financial markets. Hi everyone, and welcome back to the IceCap Canadian Market Wrap with me, your host, Richard Diaz. In this week's episode, episode 5, we'll be talking about Canada's looming recession. At IceCap, it's our view that the probability of Canada experiencing a hard landing, a recession where a large number of people lose their jobs and businesses shutter, is very high. Indeed, Canada might actually already be in one. One challenge for Canadians is that basically nobody alive has ever really witnessed a true blue Canadian-made recession. All other previous recessions have been created outside of Canada, and this has created sort of a sense of invincibility amongst Canadians. To explain why we think what we think, I've split this week's video into 3 sections. Section 1, what is a recession and how is it defined? Section 2, a quick history lesson. You guys know I love a history lesson. And Section 3, a recession by any other name. So let's get started. What is a recession and how is it defined? A recession is a significant, widespread, and prolonged downturn in economic activity. This is a rather simple definition. It's an overarching one that's not very specific, and that's why the next slide is really helpful. It's a rather arbitrary number, but 2 quarters is a threshold that helps ensure that a downturn is not just a short-term fluctuation, but rather, as we said, a sustained period of economic decline. There are different shapes. You can have a V-shaped recession or an L-shaped recession, but basically they all sort of tried to measure the same thing, which is this period of economic decline that lasts a relatively long time. A quick history lesson. I love a history lesson. They really allow you to contextualize things. In this case, they're going to help hammer home the point that all previous recessions that anyone alive has been around to see have been from outside of Canada, have been caused from outside Canada. You can see the oil embargo in 1973, whether it's the Volcker and the double dip, you got the Gulf War, you got the Great Financial Crisis, of course, was caused by the housing bubble in the U.S., you got the oil shock that affected Alberta, but the rest of Canada basically went unscathed. And most recently, of course, there's COVID. I've taken those 7 recessions and I've put them onto the following chart. And you can see that the blue line is 1 quarter of GDP growth. 2 together, as we said, constitutes a recession as it's defined. And the gray shading helps you sort of highlight exactly where we are with respect to those recessions and how long they last. And it's a useful indicator that you'll see in a couple of charts going forward. A recession by any other name came to me when I was thinking about Canada and whether or not we're in a recession, what's going to happen going forward. And for those of you who may not know, this is a quote from William Shakespeare's play, Romeo and Juliet, where Juliet says, "A rose by any other name would smell as sweet." And so the reason I think this is really important when you think about Canada is just because we don't necessarily hit the definition of a recession, there are many other indicators that suggest we are in a sustained period of widespread economic decline. And I'll show you exactly what I mean by that, because the following chart is a zoomed in version of the one we saw before. The blue lines, the blue bars are GDP growth per quarter. And in 2020, you can see those 2 consecutive quarters of negative growth. And indeed, we have a recession. And then again, you can see right now, we actually have no negative quarters. And you say, Rich, why do you say a rose by any other name? And we're going to go over some of the evidence. But before that, I want to talk about sort of the expectations and how how IceCap has a differentiated view from those expectations. And the first set of expectations we have are consensus estimates of GDP growth going forward. And these are forecasts based on sort of the median expectation of economists. So they line up a bunch of economists, they ask them what we think is going to happen, and they spit out this number. The next set of expectations that we want to challenge are the government's. This chart is from the government's spring budget, and what I've highlighted are similar to the expectations I've shown you before, but slightly different in the way that they calculate it. And again, what you can see is that for 2024, there is no view, the view that, that we're going to have any kind of downturn this year or next is not at all baked into their projections of revenue or taxation or spending or what have you. And I think that's an important consideration. And we just think that, not enough people are worried about the possibility of a widespread downturn in economic activity. So that's sort of, what people are thinking, and why our view is differentiated is going to come up over the next few slides. So the first of these slides that I want to talk about is the fact that consumption remains very, very weak. In episode 3, we talked about GDP and how it's made up of government consumption and investment, business investment, household consumption, and net exports. Canada's about 65% consumption, and household consumption is a key contributor to our economic activity. The following chart is retail sales, which is not quite a fair comparable for overall consumption, but is useful in describing what I think is overall weak household consumption. And this is retail sales in real terms and nominal terms. And what's fascinating about this chart is even though Canada's population has grown substantially over the last few years, retail sales in real terms, so adjusted for inflation, have been flat. And that's an indication of, again, this real malaise that you can see in what should be a large portion of your overall economic activity. The next one I want to talk about is weakness in the labor market. So this is related to household consumption, but sort of a little bit different in the sense that you can see the changes are quite acute over time, specifically around these recessions. And so remember I referenced the fact that there was some gray bars that highlight the 2 or 3 or consecutive quarters of GDP growth that decline. And here you can see that when those gray bars, so when there's a recession, labor markets tend to do badly. And you can see the blue line is the unemployment rate. Red line is straight up number of unemployed. And so you can see it rising over here in 1980s, again in the 90s, again in 2010. There was a small blip in 2015, and then again here in 2020. And one of the reasons we argue that there is a recession on right now is this massive increase in unemployment and the unemployment rate. Another reason why we're worried about the looming recession is industrial production and business investment. So first we've talked about household consumption and retail sales and the labor market. Well, the other side of it is what business are doing or not doing. And here again, you see when there's been an economic downturn, you've seen a decline in business investment and industrial productions. So again, 2008 and 9, 2015, 2012, and again, right now, you see that business investment is very weak and declining, and industrial production has basically been flat over the last few years. So what about Canadian banks? The financial sector is an important part of any developed economy. It's especially important in Canada, where they take up a lot of oxygen, both from the political standpoint, equity market standpoint, and certainly a credit creation standpoint. And we feel that they haven't fully grasped the situation. This is an important disconnect from IceCap view. Again, the consensus estimates are for more growth this year and even next year. The government shares this rosy picture, and we feel that Canadian banks are also sort of behind the curve, and that's what this chart shows us. Here we've just shown a random Canadian bank, but rest assured, the rest of them all look almost exactly the same. And what this chart shows us is provisions for loan losses. Now, what are provisions, you might be asking? It's the money that's set aside for a potential default or for when a loan goes sour. And on this chart, you have the yellow bars, which show you an absolute level of provisioning, and then the light blue line, which shows you as a relative share of your total loans, how much have you set aside. And what's really important to note on the right-hand side of this chart is how low that provisioning actually is. So yes, in absolute terms, we're talking about big money relative to history, but again, relative to its own loan book, which has grown over time, it's actually quite low. So just like the consensus forecast for GDP growth and the government's view of growth going forward, we think that banks are far, far too sanguine on what's going to happen to economic activity. If they were more cautious about the outlook, we think that their provisioning would have already reached to much closer of their previous peaks relative to their total loan book. The next chart highlights why a lot of this discussion is sort of academic. And I'm reminded again of the quote, "A rose by any other name is still a rose." That's because on a per capita basis, Canada has been in a recession for almost 2 years. The reason that the headline figures haven't been negative is because we have historic population growth, and that population growth has floated those headline figures. It's keeping them higher than they otherwise would be on a year-on-year basis. So what do investors expect and worry about and think about if and when this recession happens, or this economic decline continues or even gets worse? And we expect volatility. And volatility is a financial market euphemism for losses. And these losses will, in our view, affect many risk assets, but especially the dollar. And again, here we can see that we have evidence for this sort of thing happening before. In 2008, when you had a recession, the Canadian dollar sold off. That's what this blue line is, rising. Going up means that it's getting weaker. Again, in 2015, when Canada suffered a recession, the blue line went up. That means the Canadian dollar sold off. And in 2020, again, Canada's currency sold off. This blue line went higher. This red line, if you're asking, is 3-month volatility. So again, it's just another measure of volatility. And that volatility is what we expect to happen when Canada's economy continues down the path that it's going. That consumption remains weak, that labor markets continue to falter, that businesses continue to hold back investing and industrial production gets worse, and that banks, which will finally be forced to catch up, provision for more loans losses, and restrict credit even further, which will circle back into the other parts of the economy. So that's a wrap on this week's episode. Thanks for listening. Please like, subscribe, and follow for more. And always feel free to get in touch with me.